Hello everyone, today is Friday, May 20th, 2022. My name is Evan. Welcome back to our weekly stock market analysis video series. If it's your first time tuning in, welcome. Thanks for being here. Thanks for joining us. Here's how these videos work. We break up our analysis into two parts. In part one, we look at everything that went on this week in markets beyond price action. So we look at things like interest rates and commodities and market internals and really sort of just pick apart things that stand out, look different or interesting. And then in part two, we jump into those charts, we analyze price action, we break down the key levels and look at some other key charts and sector and industry movers. So hopefully that sounds good to you. Thanks, by the way, everyone last week for all of the well wishes. I was under the weather, feeling much better this week. So thanks for that. And let's jump into some of the headlines here. So we had kind of the big story here is the S&P 500 finally crossing into the 20% correction territory. Lots of folks will use 20% as the official sort of bear market nomenclature. That's fine. If you want to call it that, if we're in a bear market now, that's fine with me. I think we've been in one for, the past couple of weeks or months, arguably. There's nothing really new here. Many stocks have sort of entered into that 20% correction 2 months ago, 3 months ago. But the indices at this point are starting to catch up. Notice though, last week we had the Nasdaq, in fact, actually exceed a 30% correction. So the S&P 500 is not leading the charge down. It is finally sort of catching up a bit here, as we'll see in the next slide I have. Bonds and gold finally starting to hedge. This is a new behavior here. We actually saw interest rates start to peak out. We're starting to see the bond market actually find some support or at least cool off a little bit. The trend is still very much intact here for interest rates, for the bond market, for the treasury market, but at least we're seeing some stabilization, and that can give us some hope that if the fixed income market can finally start to stabilize a bit, maybe that gives us the chance that the equity markets can then rally. We also saw gold start to work this week, so we'll talk about that a little bit later in this video. And then we also had this week May option expiration, as I put in there, shenanigans. Lots of fun stuff can happen on option expiration date. I think we saw that this Friday, in fact, because we did see prices intraday get pretty low or pretty distorted and ultimately, rebound significantly into the close. So we'll talk about that a little bit later as well. Now, if we take a look at equity market performance here, you can see on the week, it was nothing that exciting. If you're a bull, we saw continued downside action here, 3%, 4% in some of the major indices here. That is significant. We saw the Russell 2000 notably stand out a bit, 1.5%, so some good relative outperformance there. And then take a look at world stocks. That is quite notable as well. So if you were outside of the United States this week, you actually had a pretty good week. And then take a look at the 1 month numbers here for the ACWX. That's the proxy we're using for world stocks minus the United States. It's down 3.5% over the past month. It's a lot better than anything else going on here in the United States. So definitely some opportunity, some relative strength there across the sea. Now, if we take a look at drawdowns here, I wanted to throw in this piece of information. This is drawdowns from 52-week highs. These are approximate drawdowns. They may not be exact, so don't hold me to the double or triple decimal points, but approximately here we can see the Dow Jones 15.61% from its 52-week high. It's actually faring the best out of the US major indices here. The S&P 500 approximately 20% down, Nasdaq 30%, Russell 2000 give or take 30%. So we are seeing some pretty significant drawdowns at this point. And I've talked to a lot of traders, get inbound emails a lot. A lot of folks, sometimes on the longer time horizon here, worried about the market, worried about the recession. How bad is this going to be? And obviously, nothing financial advice as we throw disclaimers out left and right. But I mean, at these types of levels, right, 20, 30% corrections in the major indices, if your plan is a longer term investor, then this is your time to dollar cost average, right, to get into the market. If you're a short term trader, right, and you're trying to play for the next 3, 4, 5% move, that could equally be down as it is up. But I mean, if you're a longer term investor, if you're a young investor, you want discounts. You want to buy stocks while they're cheap. You want to buy stocks while nobody else wants to own them. And we're certainly seeing periods of this. Doesn't mean there's not risks. Doesn't mean we can't see 30 and 40 and 50% corrections. It's certainly possible. But if you are a long-term holder of stocks, investor of sorts, then, this is what you're really playing for. So that's a little bit of a side there, but I've been, answering lots of emails, or at least talking with lots of traders with a similar question. And those are sort of my thoughts in terms of the longer term crowd. If we take a look at market internals here, you're starting to see number of stocks hitting 52-week lows dry up a little bit. That is at least, again, mildly encouraging. We're still seeing more stocks hit 52-week lows than highs, but we're not seeing, the 1,000 plus or 800 plus stocks hitting 52-week lows. So at least a little bit of a reprieve here. That's good to see. AD line was slightly negative this week, and you can still see there's only 20% of stocks above a 20 SMA. So we're pretty, kind of oversold and hated out there in the market. If we take a look at NYSE 52-week highs minus lows over the past month, should not be a surprise. Very strong downtrend here, starting to go a little more gradual, but all things equal, still pretty pessimistic. If we take a look at VIX this week, not a whole lot of change. The blue line is this week. The orange line is last week. And you can see basically we just bumped up a little bit. So we're still under 30. This market, the S&P Volatility VIX, has been very reluctant to stay over 30 in this continued sell-off here in the market, but we do still pretty much see a fairly flat looking term structure for volatility, which basically shows the fear out there in the front month of this market. If we take a look at sector performance, you can see most things in the red this week. On the upside, though, there were 3 sectors in the green. It was energy, it was healthcare, it was utilities. Very defensive, and energy is, I guess, well, it's not defensive, but we're, often find itself in the defensive bucket. Given all the inflation that's out there from energy prices, continues to, typically trade with the safety assets. On the downside, take a look at this. Consumer staples, 8% move. That's a huge move for consumer staples. We're going to talk about this later when we look at the charts. Consumer discretionary down almost 8%. Industrials down 3.5%. For staples, we had the announcements out of first Walmart and then Target, I believe was the order. Both of them seeing, sort of warning signs or slowdown in the consumer, and that certainly sent prices making some extreme moves. We're going to look at that a little bit later. Interest rates. So here we go. This was, again, some of that stabilization we're finally starting to see here. It's the second week in a row we're seeing interest rates pull back and cool off. That is a good thing. That is what you want to see in this market. The only way we're going to get equity markets to stabilize is if we can get yields to stop just screaming to the upside, and we're at least getting 2 weeks of that this week, or this week and last week. Again, 2 weeks does not make a trend, does not reverse a trend, but it's at least a start. So that was certainly encouraging. If we take a look at the dollar, this was one of the biggest, I think it was the second biggest down week for the dollar this week. That's also a good thing for the markets. You want to see the dollar cool off as well. You got that this week. You saw gold working, silver working, lots of commodities continue to work. Bitcoin's still pretty mixed here, but generally speaking, some pretty favorable action in terms of dollar and some of those commodities. Correlations, really nothing new here. Figured I would just throw the information in here. I compute these and crunch these numbers week to week. So hit pause, take a look at this yourself, but this is pretty much very similar to what we've seen in recent weeks. Last but not least, our positioning here. So where are our dollars invested? Well, there's not a whole lot of dollars invested, so very defensive. In the top here, Merlin, our longer term trading system, this is actually holding on to a position in gold right now, and that's what you see right here. So it's basically cash and gold, not going to get any more defensive than that. Our shorter term system here does have some shorts on, so it is net short the market right here. So very, very risk off at this point. I do think we could muster up a bounce here in the markets. We'll talk about that in just a little bit. That's my personal decision making there. But these systems are fully rules based. They run without me. They are coded. They are back tested. They are researched. And this is their current positioning. They will change, of course, as the market changes. But for now, very defensive in our positioning here. So if you want to learn more about these trading systems, we've got a lot of documentation on our website. You can check it out. You can take a free trial. Or sorry, not free. It's $1 now. $1 trial, see if they're the right fit for you, and give them a spin if you're interested. So with that, we'll be back here in just a moment with part 2. All right, we're back here. We've got TC 2000 open, and we're going to jump right into some price action analysis. We're looking at the S&P 500 cash settled market. Now, this has been the roadmap we've been looking at here. Remember, we had this, significant support area around 4,200, 4,180, that band in here in the S&P 500. We sliced through it a few weeks ago, and this is where we basically said all bets are off. This is where, bad things happen. This is where the trend can really expand to the downside. And that's pretty much what we've seen since we broke down from this area. Note, we did have this attempt last week and early this week, we got this nice little rebound rally going on here in the market. It started last Thursday. We talked about it. We talked about the follow through day on Friday. And so our last week's analysis was basically, we've got 2 levels now we can trade against as traders. And the low from Thursday was the area we said we can start managing some risk against. It was right in here around this 3870 area. I don't know that that's the exact view we used. I think we drew some different annotations here. But the point was, we talked about the low that we had here, and then we talked about this area right in here, which was this follow through gap up session on Friday. So we basically said, look, if you're a shorter term trader, if you're looking to, swing trade, day trade, get optimistic on this market, you finally had the reversal day and the follow through day that you could use to manage risk against. So that worked nicely here for basically 2 days. Monday was an inside session. Tuesday we rallied higher. And then boy, oh boy, did sentiment change on Wednesday. We had this big expansion lower here in the markets. We broke this little uptrend we had. Some might call this a bear flag that we were forming here. We broke below Tuesday's lows and came crashing down. 4% down day in the S&P 500, over 5% down in the Nasdaq. One of the worst days we've seen in recent weeks, months, and well, frankly, years, ranking up there. And then we proceeded to essentially find some small follow through Thursday. And then we had a lot of volatility on Friday, but lo and behold, we did close flat on Friday after probing all the way down to about 3820 or so. 3810 in the S&P 500. So, basically here we're left with a similar level on the low from Thursday the 12th. So we have some silver lining here that support this low. This outside little reversal session we put in on Thursday did in fact hold on a closing basis. It was rough here on Friday. We moved right below it. Again, I called it options expiration shenanigans, but whatever the case was, right? We don't need necessarily a reason. We don't need to know why, but we do know that on a closing basis, we did manage to hold over Thursday's lows. That is a silver lining here in a, generally speaking, pessimistic, bearish market environment, right? We've got the downtrend in place here. We've got lots of negative things in the data, but we did see from at least a price action perspective, we held on to Thursday's lows. So if I'm a trader now looking at this going into next week, I want to see follow through back to the upside. I want to see this to be the actual low. Option expiration is out of the way, and I want to see if some of this positive momentum divergence that is starting to creep in here is actually going to pave way for some type of relief rally. Remember, we did talk about the bond market. Let's just go right to it here. So if we look at the 10-year bond market, you can see that it stabilized this week as well. You can go down to the long end of the curve, TLT, right? 2 weeks now where we're not making new lows in a very strong downtrend. We'll see if this can continue to hold here. We'll see if the VIX can continue to stay underneath 30. We'll see if the dollar, right? We're going through all our major markets here. Dollar on a weekly chart, this was one of the biggest down weeks we've seen, 1.5% for UUP, heavy volume coming in here, maybe a trend reversal, maybe some interest rates stabilization going on here, and maybe some positive divergence in the equity market that could start to put in a low and some type of at least short-term relief rally for equities as a whole. You could also even go further to, let's go to the ARC, for instance. So ARC used as a proxy for growth and for risk appetite. Take a look at the way this finished out the week. Lots of consolidation here. But notice we didn't come all the way back down and test these lows. These were some of the hardest hit stocks. They are just the hardest hit stocks, period, I'd say, in the market right now. They were one of the first to top out and lead the charge down many months ago, and you're starting to see, again, a little bit of stabilization. You saw even in the small cap. So Russell 2000, we talked about the relative outperformance this week. So we didn't get down and take out these lows like the S&P 500 did and like the Nasdaq did. It put in some type of higher low here and is trying to show some relative strength. So we've got a lot of under the hood where you have to look a little bit closer here and connect the dots of some signs of stabilization, some signs of different messaging happening in the market. We still have downtrends. I still think caution is advised. I still think you have to manage risk. And I still think, yes, we could go lower. But if we want to put our magnifying lens out there, we can see that there are some subtle signs that we could be setting up for some type of reversal. So know your time frame, know what type of trader you are, and hopefully that information is helpful. If we take a look at the Nasdaq 100 here again, you can see very similar to the S&P 500. We did take out Thursday's lows, but then we did proceed to close above them on a closing basis going into the weekend. So that is at least notable. And again, MACD momentum divergence here is still happening. So that was really touring sort of price action and the major markets that I wanted to look at. Oh, I wanted to look at consumer staples. So this view here, I think, illustrates it nicely. This is a new layout we built for TC2000. It's called our rolling returns layout. I don't really care about the rolling returns. I do care about these indicators I've built here. So this is looking at, this indicator here is looking at daily movement displayed in ATRs. So basically just expressing movement relative to the average true range. And if we take a look here at the XLP, take a look at this huge spike up here. So we basically got a 3 ATR move on Wednesday, the 18th. So I believe this was when Walmart reported its earnings. You can see it had like almost a 5 ATR move on Tuesday, the 17th. So this type of move is quite significant. You can actually look at it on a weekly basis and take a look how off the charts we are for XLP. This was an 8% down week, which again, if you're looking at 8% down in something like an ARK, it doesn't necessarily even move the needle. Take a look, if you look at where my cursor is, this was a 10% down week for ARK, and look where we are. We're in the middle of this range. This is why this indicator is cool, is because it is expressing relative to the actual instrument, right? So it helps you actually see when there is significant movement. XLP totally off the charts here on the weekly time frame. This is a very significant move, and you can just see it going all the way back. And in fact, you can see it right back here as COVID is the last time we had a spike all the way up to those levels. So I think that was interesting. I thought that was notable. I wanted to share it there. And that's our new rolling returns layout for TC2000. You can download that if you're a user. So last but not least, industries and sectors. There's nothing good here on the bullish side. So our scans that look at sectors and industries, nothing showing up this week. If we go to the bearish side, we take a look at things that were not faring so well. We had agriculture inputs. You can see kind of closing towards the bottom end of the range here, slightly higher volume. Building materials continuing this downtrend. Business equipment making new lows. We see department stores really expanding to the downside. So again, thanks Walmart, Target, and those reports. Discount stores, again, defensive area. This is probably Dollar Tree and some other things happening going on here. Farm products, new lows, extremely heavy volume. Food distribution coming back down. Grocery stores coming down. Home furnishing and fixtures and household and personal products, new lows. Integrated shipping, new lows. Pharmaceutical retailers, new lows. Recreational vehicles, new lows. Hotel and motel, new lows. Semiconductor equipment, new lows. Trucking, new lows. And XLP outright, like we talked about, heavy volume and new multi-month lows. So there you have it, the roundup there on markets. Again, risks still are plenty out there, so be careful. Focus on risk management protection first, but there are definitely some subtle signs underneath the hood that there's some things shifting in terms of maybe fixed income, gold, the dollar, and the volatility markets as we described. So that's all I've got. Thanks as always for tuning in and watching. Every Friday we do our long form market analysis just like this. As always, love to know what your thoughts are. Leave a comment below in this video. Let me know what you're looking at this week. You think we can get a bounce, or you think there's just more downside ahead? Let me know what your thoughts are in the comment section, and don't forget to subscribe to this video if you like it, if you want to stay up to date, and if you want to keep up to date with all of the newest that we publish. Thanks so much. Have a great weekend. We'll see you back here next week.